Mortgage. Are you guys there? Are you guys there? Do I have you? I think so. We're good? Okay. I glitched on my end. Did I glitch on your end? The internet's great. Okay. Graduated payment mortgage. With a graduated payment mortgage, your payments are lower at first, and then they're going to increase, usually at predetermined times. Your interest rate is the same, but it's what you're paying on the principal. With these, it's not uncommon at first to have negative amortization. Negative amortization means that at first, those payments you're making isn't your total debt service. It's not the total amount due. So instead of deducting from the balance on step 3, you would be adding to the balance on step 3. As your payment goes up, as your principal goes up, then you'll eventually switch over and start paying that off. Graduated payment mortgages might be good. A good example of who would do this might be think of like a startup company, a startup business. I don't have any money right now. I'm just getting started. But as I start making money, I can afford to pay more principal. Thus, my payments can graduate. So negative amortization is a thing. If you're not making the monthly payment, that monthly debt service, then instead of adding or deducting from the balance, you'll be adding. Balloon payment is what you have left. If you have a partially amortized loan, you make that last payment and you still have an amount due. That amount due is referred to as your principal. Some of us on this call, not all of you, but some of us on this call may remember payment coupon books. And whenever you owed something, they'd send you the pay and you tear off, you'd rip off a coupon, and that's what you would write a check with and mail it in. Wow, I just said a lot of old words, didn't I? Coupon, check, mail, right? So that's the way we used to do it. And when you tore off the last coupon, that was your last payment. If you still have a balance due, that's your balloon payment. You know, going into this, when you make your last payment, you'll have that balloon payment. Same thing with the interest only loan. All you're making payments on is interest. You make that last payment, your balloon payment is your principal. I love that, Jen. That's awesome. She says her husband still does it that way. Keeping old school things alive. Thank you. Internet schminternet, right? Last thing we have there. That's great. Last thing we have there is a growing equity mortgage. With the growing equity mortgage, you are, let me see, you're growing your equity. Your equity is your principal. So your interest payment is the same. Your interest rate is the same, but you're going to make more and more payments on your principal. Principal is your equity. It's what you have in the property. So your payments are going to go up at a predetermined time. We're going to agree on a time. And you're going to be paying a little bit more on the principal, a little bit more, and a little bit more. Your interest rate stays the same. May allow you to pay it off a little bit faster. More on equity in 12 when we get to property managers, property management. So we'll see that again. So again, those are all green stars except for the fixed rate. That's a yellow star because this is the math we just did. This is what we spent our time talking about. So just a basic understanding of these other loan repayment plans. And that gets us through Unit 14, halfway through financing. So we got those key terms on 383. You got your key point review on 403, and then you have a student quiz on 405. Please turn with me in your book to page 407. 407. You guys see on 407, there's those last three questions there, 28, 29, and 30. These questions build off of each other, and I really like these because if you do financing math, 28, 29, and 30 is a great exercise. With that being said, the problems that we just worked, when we amortized, they gave us the monthly payment. They told us $499.55. The problem may not always tell you $499.55, in which case we have to find the monthly payment. We're not going to learn how to find the monthly payment until Unit 15. So we'll learn if they don't give you that $499.55, how can you find it? 28, 29, and 30 on 407, you're expected to find the monthly payment. So I suggest holding off on those three problems for now until we get through Unit 15, until we teach you how to find that monthly payment. So just make a note, hold off on those until next week when we do our Unit 15 math. Back to Unit 14 math. There's those math concepts. Starting on page 400, it goes over stuff like discount points and amortizing and interest over the life of the loan. There's more math in the math concepts than what you need to know. There's more math than what you need to know. So just stick to what we talked about in class. I'm following the syllabus. So just stick with what we talked about in class. And then there's those 50 problems in the back of the book. These are the numbers that relate to Unit 14 math. These are the numbers that relate to what we just did. Questions about 15? Is anybody a mortgage lender, by the way? Anybody have your mortgage lending license? It's not uncommon. Some of you are like, oh God, no, absolutely not. I hear you. I hear you. It's not uncommon for mortgage lenders to show up. Sometimes you're licensed and you want to get more in the lender world. So you go into lender. Sometimes you're a lender and you want to get more in the real estate world. But based on several of yours reaction, not going to happen. I hear you. I hear you. Okay. Big deep breath. Unit 15. Still financing. We still have our lender's hat on. 14 was the principles. Now 15 is the more in practice. So even though we still have our lender's hat on, this is more of what we need to know in the real world so we can help our buyers, specifically as they're talking to a lender obtaining a loan. Always remember, you guys, stay in your lane. So if your buyer has some basic questions about their loan, we could probably address those for them. But once they get a little bit more in depth, then we need to know when to refer them to their lender. Let their lender answer these questions. But we are looking for a basic understanding about how financing works in practice. So our roadmap for this unit, we're going to talk about the different types of loans. There's conventional loans, there's FHA loans, VA loans, USDA loans, all sorts of mortgage loans that your buyer may apply for, qualify for. We're going to describe the players in the mortgage lending practice, and we're going to talk about what each player's role is and how that affects the overall lending practice. We're going to explain some basic residential lending practices and procedures, some basic things that the lender's looking for, basic understanding of how they approve or pre-approve or pre-qualify a borrower for a loan. And then we have some more math. We will not get to this today. So next week we can look forward to some more math. on finding that monthly debt service. And we're also going to look at the math on how you could qualify your buyer. So if your lender's not available, if they can't give us a pre-approval, we want an idea, a rough idea, if the buyer can even afford this property that they want to see. So we're going to get a basic understanding on how we could qualify our buyer if the lender's not available. So starting unit 15 on page 410, we're going to start by talking about where we are today in the financing market. And a lot of where we are today in the financing market is a direct result of the housing market crash that we suffered through in 2008, 2009, and 2010. There are a cajillion theories out there about what went wrong and caused the housing market crash. And we're not going to get into all of the theories, but I will say one of the more popular theories was fraudulent lending practices. Not all lenders were up to up. Not all lenders were good and honest people. Some lenders were giving loans. Some lenders were like Oprah out there giving loans. You get a home loan. You get a home loan. Everybody gets a home loan. Do you qualify? I don't care. Take a home loan. Do I have to prove to you I can make the payment? Doesn't matter. Have a home loan. Can you see part of the reason why we got into the problem that we got? We were giving money without making sure people could pay it back. They went to default, foreclosures and short sales were up. It was a mess. Remember, real estate is always a market. You're always going to have highs and lows. But the housing market crash was really, really low. And the idea of some of these laws that we have into place now, some of these things, lender laws that we have into place now, we're still going to have lows in the real estate market. That's how a market works. But hopefully with these laws in place, we won't go that low again. It was tough. It was tough. So we have Dodd-Frank came to be in 2010. Dodd-Frank is responsible for some of these lender laws that we have today. So Dodd-Frank 2010 started the Consumer Financial Protection Bureau. The Consumer Financial Protection Bureau was set up to protect the consumer. The consumer that we're referring to is the borrower. So protecting the borrower when they originate a new loan. And we got a brand new shiny law in 2015 called TRID. TRID was born in 2015. TRID is the acronyms of all acronyms. Acronyms within acronyms. So let's define TRID. TRID is an acronym for the TILA-RESPA Integrated Disclosure. TILA is an acronym for the Truth in Lending Act. RESPA is an acronym for the Real Estate Settlement Procedures Act. TILA has been around since like the 60s or 70s. RESPA has been around since the mid-70s. TILA and RESPA are nothing new. But part of what they did after the housing market crash, they combined them, they integrated them. TILA has their set of forms, their own purpose. RESPA has their set of forms and their own purpose. And oftentimes, those forms are very similar. So it almost looked like duplicate content. And consumers were confused. Like, didn't I just sign this? I signed a form that looked just like this. Yeah, but that was for TILA. Now I need you to sign a similar form for RESPA. And it was confusing. And they decided one way to make it easier for consumers was to integrate them, was to consolidate them. So we don't have duplicate content. Makes the process easier to understand. Makes it easier for consumers. And guys, don't get me wrong. I don't want you to think all lenders were fraudulent. Please don't. Let me be very clear here. Not all fraud lenders were bad, but it's the bad ones that really kind of made the difference, got us to where we are with the housing market crash. Today, even though they're integrated, they still do two different things. When you guys see the word TILA, what I really want you to see is the word lending. TILA tells the consumer the cost to obtain the loan. How much is it going to cost me to borrow this money? When you see RESPA, I want you to see the word settlement. RESPA tells the consumer the cost to close. TILA tells us what's it going to cost you to get the loan. RESPA tells us what is it going to cost you to close. And that forms what we have today with TRID. We're going to talk a little bit about TILA in Unit 15. Probably won't get to it today. But we're going to address how TILA affects us in Unit 15. We're going to talk a little bit more about RESPA and TRID in Unit 21. We're getting closer and closer to closing. Questions so far? So when it comes to mortgage lending practices, there's several different players. There's several different tiers that are involved in mortgage lending practices. I don't know about your automobile lending practices. I don't know about borrowing money from a bank. We're talking specifically about mortgage lending practices. And the first tier, the first player in the mortgage lending practice are the feds. It starts up top with the feds. The Federal Reserve System is meant to keep favorable conditions in the economy. The Fed recognizes that markets fluctuate. They understand that there's highs and lows. The feds are in place to hopefully control. We don't want the high to be too high. We don't want the low to be too low. So the Federal Reserve System is set up to regulate the money going in and out of economy. It sets those interest rates. It gives us a range of interest rates. Always remember, lenders are free to charge whatever they want to, but the feds say within this range. They require banks to have reserve requirements. They have to have money that they can't lend. They have to have a reserve. And then for our purposes, the big thing that the feds do is they lend money to the lender. Remember what we said. When you call the lender and ask for money to buy a home, the lender's got to get that money from somewhere. And if they are borrowing money from the feds, do y'all think the feds are going to charge our lenders an interest rate? Are they going to charge the lenders to borrow that money? You better believe it. The feds are investors lending money to the lender investor. So if they're borrowing money from the feds to give to you, part of what they have to do is roll those costs over to you, roll those costs over to us. There is no such thing as free money, even with the banks, even with the lenders. So the feds are the first player, the first tier. The next player is the primary mortgage market. This is where you and I go to borrow money. When you want to originate a loan to buy a home, you are going to a player in the primary mortgage market. Many banks will offer a mortgage loan. And then you may have independent mortgage brokers. There's Fairway Mortgage. There's Movement Mortgage. for example. So whenever you and I decide we want to buy a house, and I don't have the cash to buy it outright, so I need to borrow some money. So who I am talking to, who is originating my loan, is a player in the primary mortgage market. Their money comes from finance charges, which could include discount points. It could include loan origination fees, whatever they need to charge you for the loan. And then if they service the loan in-house, other income for them could be your interest payment. If they sell it, then the new lender will receive that interest payment, will collect that interest payment. So you and I originate money from the second tier, the primary market. Like we just said, they got to get this money from somewhere. If you want to buy a home and you want a home loan for $100,000, they got to get that money from somewhere. So they have two choices. They're either going to borrow it from the feds with interest, with terms, or they may sell your loan once it's originated. You've bought the home, the deed of trust has been recorded, and now they may sell your loan to a player on the secondary mortgage market. The secondary mortgage market is who purchases loans from the primary. So they originate your loan. The house is yours. You have the deed of trust. And most lenders will sell your loan to a player on the secondary mortgage market. The whole reason they do that, lenders only have so much money. And let's say this lender has money, and we're talking like thousands, hundreds of thousands of people. Who knows what kind of dollar signs we're looking at here? I can't even fathom all those columns. But let's say they originated 1,000 loans this month. When they sell your loan, those 1,000 people's loans, they have replenished their funds. They have given themselves more money. So now they can originate 1,000 more loans. They don't have to wait for you to pay them back. They're going to sell your loan so it can replenish their funds, so they can originate more loans, so we can keep money flowing in the economy. And real estate is a fantastic source to flow money in the economy. Think about the dollar signs that we're talking about here with these properties. So the more the lenders can replenish their funds, the more loans they can originate. So, well, they have choices. The primary mortgage market can either purchase from the feds, or they can sell to the secondary mortgage market. Three choices. They could also keep it in-house. They don't have to sell it. They could keep it, and they would collect those interest rates. You guys have probably heard of some of the players of the secondary mortgage market. I would almost be willing to bet that we've all heard of Fannie Mae. Ginnie Mae, maybe you've heard of. Freddie Mac, maybe you've heard of. But Fannie has been around for a long, long time. These are our players in the secondary mortgage market. These are the people that purchase loans from the lenders, the primary mortgage market, to replenish their funds. Fannie Mae is the oldest, the biggest, and the hungriest. Fannie will buy it all. She's going to buy conventional loans. She's going to buy FHA. She's going to buy VA loans. All the other loan types, Fannie doesn't care. Fannie will buy it. She's the oldest and the biggest. She's been around the longest. Ginnie Mae is a little bit more particular. Ginnie will only buy FHA and government loans. I'm sorry, FHA and VA loans. Now, I understand, as I just said, I understand we haven't made it this far yet, but we're getting ready to learn that FHA and VA loans are government loans. They're government-backed loans. The way I always remember this, GG. Ginny buys the government loans. Ginny buys the government loans, FHA and VA. More on that in just a second. Freddie's the pickiest one of them all. Freddie will only buy conventional loans. So these are the players on the secondary mortgage market. These are the people that buy from the primary. They're not originating loans to me and you. They're buying the loans once they're originating. And the whole point of that is to replenish the lender's funds. I've lent out, I had 1,000 borrowers, and I've lent out all my money. I have two choices. I either collect from those 1,000 borrowers every month for the next 30 years, or I sell those loans, replenish my funds so I can originate new loans. All lenders are different. I like to point out to you guys page 414 and 415. Please read this on your own time. This is our little history lesson about the housing market crash. Some of these numbers are shocking. This is the life we were living, 2008, 2009. Kind of gives us a better understanding of why we have to be where we are today. Again, you can expect lows. It's a market. You can expect lows. But the hope is with these new policies in place, these new consumer protection in place, that the next low won't be that low. We do not want to go that low again. With the housing market crash, you guys, it wasn't just real estate that was affected. It's all the people involved in real estate. If I'm not selling houses, my home inspector isn't working, my lender's not working, my closing attorney's not working, my appraiser's not working, the pest inspector, the surveyor, all those people involved, it was tough. I remember the housing market crash. I was still an admin. I wasn't in sales yet. And even as an admin, we were working on reduced hours. We got our hours cut because it was tough. And I remember going into the office because I was the admin that opened the office and I'd always get the coffee started, you know. I remember going into the office and before I ever started the coffee, just walking up and down the halls so I could tell my broker in charge which agents cleared out their office the night before. It was like that. Every day I had to go in and figure out who wasn't there. To say we were dropping like flies, it was tough. Because if you're not selling houses, you got to do something else to put food on the table, right? So a lot of people, not just real estate, a lot of people got out. It was tough. Reduced hours meant, you know, I still had bills to pay. I was picking up some house cleaning gigs, you know, just trying to make it through. For those of us that did, we have the story to tell. So again, we're always going to have lows. The hope is that we don't go that low again. Any questions on the players, the feds, the primary market, and the secondary market? So now we're going to talk about some different types of mortgage loans. Specifically, we're going to talk about the most common mortgage loans. Remember what we've been saying. All lenders are different. Not all lenders have to offer these types of loans. They may choose which loan products they offer. They may choose their terms and their interest rate. Remembering that they have laws with that ceiling. You can charge whatever you want to up to X amount. So some possibilities with some different types of mortgage loans. One of the common ones that we see is called a conventional loan. Conventional loan is not backed by a government agency. We have several loan types that are. When we say it's backed by a government agency, what we're saying is that the government is offering a safety net to catch the lender in the event of the borrower's default. But the conventional loans don't have that government safety net. With a conventional loan, the lender bears all the risk. They don't have a safety net. So in the event of the borrower's default, it's on the lender to catch themselves. Oftentimes with a conventional loan, if the loan to value ratio is 80% or more. Loan to value ratio is 80% or more. It's not uncommon for the lender to charge private mortgage insurance, or PMI. PMI is the lender creating their safety net. Remember, all the lender cares about is, in the event of default, getting their money back. So if your loan to value ratio is 80% or higher, you're more risk to the lender. The higher the loan to value ratio, the more risk the borrower is to the lender. The lender has to ask themselves, if the borrower never makes their first payment, or they make 3 payments and then they stop, can I sell their home, pay the cost of the sale, and get my money back? The higher the loan to value ratio, the more risky the borrower is to the lender. High 80% or more for a conventional loan, the lender will charge private mortgage insurance. Conforming versus non-conforming loans. Conforming conventional loans meet certain bank requirements. And if those bank requirements are met, it means it can be sold to the player in the secondary mortgage market. It conforms to the rules. It conforms to the standards, so it can be sold. Non-conforming conventional loans then don't conform, thus they can't be sold, which means the lender will have to service them in-house. The lender will service them for the next 30 years, collecting the interest payment. So if we put what we just said, these are figures we've already seen. I have my value, which in this case is the appraised amount. Remember, the lender defines value as the appraisal or the sales price, whichever one is less. So if we have to compare, otherwise we're just given one number and we go with it. So I know my value is 100,000. I'm asking for a loan of 90,000. So my loan to value ratio is going to be 90%. Loan to value ratio, loan to value, gives me, or the lender, I should say, the loan to value ratio is through the eyes of the lender. So all we're saying is the lender's loan to value ratio is 90%, which means you, the borrower, are bringing 10%. You're bringing $10,000. You're asking the lender for 90. Because the loan to value ratio is more than 80%, this lender will probably charge PMI until that loan to value ratio gets down to 80. If you originate a loan with a loan to value ratio of more than 80%, they're only going to charge you PMI until you get down to 80%. Once you get down to 80, they'll drop that PMI because you're not the risk. You're not the risk that you were when you owed them $90,000. Now you only owe them 80. They feel more confident that they'll be able to sell your house and get their money back in the event of default. The higher the loan to value ratio, the riskier the borrower. Questions on conventional loans? And by the way, you can see that borrowers with a conventional loan of 80% or higher, that's also broken down in your amortization schedule. So the packet of stuff you got from closing, and it'll show you when that PMI falls off. And it's not much. I mean, it's like $12 a month. I just made a number up, but it's not much. But all PMI is doing, it's providing the safety net. It's insurance for the lender in the event of the borrower's default. Once you're not as risky, you usually don't have to pay that anymore. Questions on conventional? We're going to talk, I'm going to end here today, but don't go anywhere just yet. Don't go anywhere. So when we come back on Tuesday, we're going to pick it back up with an FHA loan, talk about a VA loan, talk about some other loan types. I think it's important that we hear FHA loans and VA loans are government-backed loans, which means upon approval, the government will provide a safety net to catch the lender in the event of the borrower's default. So if the borrower defaults, the lender has security. They have these government-backed loans. Because the government's involved now, the approval process is stricter. It's not just the people that have to pass approval. It is also the property that has to pass. There's more that has to happen before the government will decide if they want to offer that safety net. So we're going to pick up on page 417. I ask you guys to look ahead. We'll talk about some other loan types. Then we get into some residential residential lending practices. So we'll talk about things like your credit score, your credit report, get a little better understanding of the lender's process, what they're doing to decide if they can approve the borrower. We talk about TILA, what that means for us, and then we'll get into the math. So on Tuesday, we will finish Unit 15, and then we will probably get started on Unit 21, 15 and 21. For those of you looking ahead, 15 and 21 for Tuesday. So what's next week look like? I'm just saying Tuesday, aren't I? What about the rest of the week? Well, we get a break. Tuesday's the 22nd. We go until 2. And then, guys, we get some time off. We do not have class next Thursday. We do not have class the following week. As you guys can imagine, this is going to be an incredible opportunity for you guys to get caught up. So we have class on Tuesday until 2. Everybody heard me? Class on Tuesday until 2. And then we don't come back together again until November 5th. So I'm going to highly recommend that you guys use this time, knowing that on the 5th, we only have 2 more weeks till your exam. So I'm already starting to encourage you to use this time wisely. So we're going to come to class on Tuesday. Also remember, you guys have a midterm due. The midterm is available now. Who can remind me when the midterm is due? How long do you have to take the midterm? That's it.
Monday, yeah.
That's it. You have until Monday night. Everybody's saying 11:59 p.m. At the stroke of midnight on Tuesday. What is today? I don't know, the 17th. So at the stroke of midnight on the 22nd, the midterm will no longer be available. Please don't wait until 11:30 on Monday night. That only gives you like 30 minutes to complete it, right? So we need everybody to take the midterm by Monday night. This is the last opportunity I have to remind you to take the midterm. I am not going to hunt you down on Monday to make sure you remember to take the midterm. Is everybody good with that? Failure to take the midterm means you're not eligible to take the end of class exam. The midterm can be found in the 50% review and midterm exam. You're looking for the Julie only, Campbell only, because that's who I am. Do I have any questions on the midterm? I've had a few of you take it. Just need the rest of you to make sure you do it by Monday night. Head bobs, thumbs ups, some sorts of recognitions. Awesome. The other thing I wanted to point out to you guys, because look, you guys, it's a lot, and I understand that. Let's have some fun. Have you guys found these review games in the online learning system yet? Review games are kind of like a matching. Aren't they fun? I've had a lot of students tell me they're fun. So they're kind of like matching such things as like agency categories. So this kind of revisits universal, general, and special. If you need to take a break from your book, you need to take a break from the YouTube channel, but you feel like you want to keep studying, play around with some of these review games. They're a good time and they're going to help you grasp this information. We've not done license law yet, so don't try to do the license law review games. We just got it started on financing. We haven't made it to closing expenses yet. So some of these we're not here yet, but a lot of these we are. Agency, finance we're working on. So if you haven't found the review games, I've had previous students tell me they're fun. So take a break from the book, take a break from the YouTube channel. What questions or comments do I have? Nine to 2 on Tuesday. You guys have a great weekend. Study hard, play hard, have fun. We'll see you guys Tuesday morning. Thank you.